To start a limited company to save tax era is over in 2026, not because limited companies are disappearing, but because the rules, the costs, and the risks have changed so dramatically that the default go limited advice is now outdated. As an accountant, I see the same mistake every single week. New directors setting up companies because someone in the pub said, just pay dividends. That is how you save tax. But from April 2026, the entire landscape shifts. Dividend tax increases, companies' house enforcement tightens, ID verification becomes mandatory, annual running cost increases, and suddenly being a director is not a shortcut. It is a commitment, a structure, a compliance framework, a responsibility. Today, I'm going to walk you through tax and compliance changes that impact limited companies, 5 types of people who should not start a limited company in 2026, the one scenario where a limited company still wins, a clear test to know which structure is right for you. Stay with me, this will save some of you thousands in avoidable taxes, costs, and stress. And before we dive in, hit subscribe if you want weekly updates that keep you ahead of 2026 tax changes. What actually changes in 2026? Dividend tax rises. From 6th April 2026, the government is closing the gap between being self-employed and being a director. From 6th April 2026, dividend tax increases 2 percentage points. Ordinary rate from 8.75 to 10.75%, upper rate from 33.75 to 35.75%. Dividends are not gone. They just are not the magical tax saving tool they used to be, especially for people who withdraw every penny of profit to live on. Number 2, Companies House tightens ID verification ongoing through 2026. The day of casual companies are over. From 18th November 2025 and rolling into 2026, every director, every shareholder with significant control must complete mandatory identity verification, meaning no ghost companies, no dormant side projects you forget about. If you are disorganized, late with paperwork, or don't want the hassle, 2026 will expose that fast. Number 3, higher baseline costs. From 1st February 2026, even if you earn nothing in year 1, you pay more just to exist. Digital incorporation fee, £100. Confirmation statement, CS01, £50. And that is before accountant's fee, payroll, software, bookkeeping, and record keeping rules. The cheap to run a company narrative is officially dead. Who should not start a limited company in 2026? Here are the 5 types where a limited company usually reduces your take home, increases your stress, and gives you no strategic benefits. Type 1. You withdraw all the profits to live on. If your business profit is modest, say £49,000, and you need almost all of that to cover your personal bills, a limited company is often worse after employer's NI, corporation tax, dividend tax, accountant fees, company's house costs. Number 2, you want a simple life, low admin tolerance. If you hate paperwork, filings, software, reconciliations, deadlines, a limited company will drain you. Directors must operate with separate bookkeeping, dual reporting, more filings, strict record rules, controlled withdrawals. If simplicity is your priority, remain a sole trader. You can always incorporate later when the business naturally grows into the structure. Number 3, your income is inconsistent or still experimental. Side hustle making £200 one month, £1,200 the next, testing different ideas, then do not incorporate yet. As a sole trader, you keep flexibility, lower costs, simpler tax rules, easier onboarding, minimal admin. Incorporate when the business model is proven. Number 4, you operate like an employee with one main client. If your setup is one main client, looks like employment, they direct your work. HMRC may apply IR 35 principles. A limited company can actually increase risk and complexity. Stay self-employed while you diversify your client base. Number 5, you blur personal and business money. If you know this is you, tap card for anything. Transfer money randomly. Forget to separate receipts. I will figure it out later mindset. Then please do not start a company as a sole trader. It is messy but survivable. In a limited company, it creates illegal dividends, director loan issues, misstated records, big cleanup costs, penalties, stress. So, know yourself. Be honest about your money habits. When should you start a limited company? A limited company still wins in 2026 if you plan to retain and reinvest profits. This is what companies are built for. Controlling timing, controlling extraction, protecting cash buffers. For example, your business earns £49,000 profit. Instead of taking everything out, you pay yourself a modest salary, retain £20,000 in the company, pay 19% corporation tax, leave £16,200 in the business, and that money is now available for investment, protected from higher personal tax, kept inside the business growth, deployed when you choose, not when HMRC chooses. For people who want to scale, hire, invest, build long-term assets, a limited company is still unbeatable. The structure is not the issue. The strategy behind it is the main issue. The real takeaway: a limited company in 2026 is not dead, but using one without a plan for growth, retained profit, or reinvestment absolutely is. If you are small, taking everything out, wanting simplicity, avoiding admin, stay sole trader. But if you are building, scaling, retaining profit, planning for long-term growth, go limited. Structure should follow strategy, not the other way round. If you want professional guidance before incorporating, you can book a call to discuss your growth plan. If you found this video helpful, hit that subscribe button.